Welcome to PNJ training. Before you can apply the current expected credit loss standard, you need to know exactly which assets it covers and what happens the moment you record one. Get those two things wrong and every allowance calculation that follows will be built on a shaky foundation. This section cuts through the ambiguity. We will map the 5 categories of in-scope assets, examine the off-balance sheet extension of the rules, identify what is explicitly excluded and why, and then walk through the Day-1 recognition rule that sets CECL apart from everything that came before it. Think of CECL as a filter applied to your entire balance sheet. Assets flow in from the top. The filter has one criterion: is this asset carried at amortized cost? That means the company holds the asset at its original cost, adjusted for any payments received, and expects to collect cash over time. Assets measured at fair value pass straight through the filter untouched. Assets carried at equity also fall outside. Only assets that sit at amortized cost and rely on future cash collection land inside the CECL scope. If an asset clears that filter, the standard applies in full, regardless of how small the balance or how remote the risk of loss. 5 pillars define the in-scope universe. First, trade receivables, customer invoices, subscription billings, professional service receivables. Second, loans receivable, bank loans, intercompany loans, and mortgages. Third, notes receivable, promissory notes, employee loans, and seller finance notes. Fourth, held-to-maturity debt securities, corporate and government bonds that the company intends to hold until they mature. Fifth, the net investment in finance leases, equipment and other assets financed through direct financing arrangements. The bottom line printed on this slide is the one practitioners need to internalize. CECL applies regardless of size, age, or how low the expected loss might be. There are no materiality carve-outs built into the scope rules. CECL does not stop at the balance sheet edge. It also captures off-balance sheet credit exposures, provided those exposures are not unconditionally cancelable by the issuer. 3 types are in scope: unfunded loan commitments, which are the committed but undrawn portions of credit facilities; financial guarantees, which are promises to cover another party's payment obligation; and letters of credit, which commit the company to pay on a customer's behalf. The accounting treatment is the mirror image of the on-balance sheet rule. For balance sheet assets, the reserve is a contra-asset allowance. For off-balance sheet exposures, the expected loss is recognized as a freestanding liability. Same economic logic, different balance sheet line. Knowing what is in scope matters less if you do not also know what is out. 4 asset types bypass CECL entirely, each for a specific reason rooted in the accounting model that already governs it. Available for sale debt securities fall under a SC 326-30, a separate subtopic, because non-credit fair value changes run through other comprehensive income rather than earnings. Equity securities follow a SC 321 and are marked to fair value with changes flowing straight to the income statement. Loans at the fair value option are covered by a SC 825, and their fair value already prices in credit risk. Operating lease receivables sit under a SC 842 and are assessed using lease-specific impairment guidance. Different measurement models, different impairment rules. Now we arrive at the rule that most fundamentally separates CECL from the old incurred-loss model. The moment a financial asset is originated or acquired, the company must immediately recognize an allowance for credit losses equal to its estimate of lifetime expected credit losses. Time equals 0 on the timeline shown here is the date of origination. There is no clock that runs before recognition is required. No grace period, no waiting for signs of trouble, no minimum loss threshold. The allowance goes on the books on day 1, full stop. This is the physics of accounting time under CECL. The loss estimate travels with the asset from the very first moment the asset exists. The contrast with the old incurred-loss model is clearest when you line up the same 3 scenarios side by side. Under the old model, A new customer invoice received no allowance unless there was specific evidence of a collection problem. Under CECL, an expected credit loss is recorded immediately using historical rates and forward-looking factors. Under the old model, a new loan originated on day one carried no allowance because the borrower was presumed current. Under CECL, lifetime expected credit loss is recorded on day one, even for a borrower with a perfect credit history. For a related party note, the old model required doubt before any allowance was recorded. CECL requires an estimate even for low-risk related parties. The paradigm has shifted from reactive to proactive. The allowance for credit losses is the balance sheet vehicle that holds the cumulative estimate of expected losses across all in-scope assets. The equation on this slide makes the mechanics concrete. Start with a gross loan of $100. Subtract the ACL reserve of $2. The result is the net carrying amount of $98, the amount the balance sheet presents to financial statement readers as the cash the company realistically expects to collect. The ACL is a contra-asset, meaning it reduces the gross balance rather than standing alone as a separate liability. Its purpose is to present the receivable at its expected net realizable value, not at the full face amount the borrower legally owes. The allowance is not a one-time calculation. Every reporting period, the company recalculates the required balance and compares it to what is already on the books. The scale shown here captures the two outcomes. When the required allowance is higher than the current balance, the company records credit loss expense. Credit quality has deteriorated, or the portfolio has grown, so more reserve is needed. When the required allowance is lower than the current balance, the company records a credit loss benefit. Credit quality has improved, or the portfolio has shrunk, so some of the reserve is released back to income. The allowance is a living reserve that fluctuates with real-time credit quality. It is never static and never optional. The final point on this slide is the one that surprises practitioners most. Reassessment is not an annual exercise. The ACL must be evaluated at every reporting date, whether that is quarterly or annually, not just at year-end. There are no exceptions and no shortcuts. The cycle shown here, Q1 through Q4, is intentional. The standard demands continuous attention to credit quality throughout the year. With scope and day one recognition now firmly in place, the next section introduces the 7-step CECL framework that governs exactly how the allowance is built and maintained each period. Thanks for watching. If you found this useful, subscribe to PNJ Training for more videos like this. Thank you for watching. Subscribe for more training from PNJ Group.